Well, good morning, everybody. Thanks for joining. We have a very interesting session this morning, covering perhaps one of the fastest growing sectors of the industry, which is copy trading. Copy trading, as we all know, has been around for a very long time, probably 10, 15 years. I think it's probably about fair to say. And on the panel today, we have three experts in this area. Maria Patashi from PLUGIT on the technology side. PLUGIT is a business that's been around since, I think, 2012. Been in the market for quite a long time, provides various plugins for MT4, MT5, and CTrader. Works with a lot of the leading brokers, very well known for their dynamic margining product. Also have a copy trading module as well, which works in conjunction with the dynamic margining. We have a lot of people would know him, Fraser Nelson, not Nelson Fraser. I don't know why I've got you as Nelson Fraser. I used to have a friend called Nelson. That might be why I've got that wrong way around. Fraser has got some big news. He's just moved to a new firm, as all markets, as of this week, I think, Fraser.
It was. Thank you very much.
Yeah. Congratulations on that move. And Barry Flanagan from ISAM Securities in Hong Kong. Barry has been with ISAM for a number of years. I think you were head of liquidity at one point, Barry, if I'm not mistaken, and has deep, long experience with managing copy trading for brokers. And I think we have a very, very interesting panel covering all aspects of the business. So practitioners on all sides. So let's start with just some interesting stats. It seems to me that copy trading, unverified statistics, but there are about 10 to 20 million individuals using copy trading around the world in various forms. Some of that might be in crypto. It's very popular in the crypto space, obviously very popular in FX and also other products as well. There's an interesting stat from eToro, probably the leading company offering copy trading in the market. They have one particular master trader who has under management about $100 million with, let me just find the stat, something like 20,000 followers or something. It's quite significant. 34,000 copiers, and he manages about $100 million in copied funds. So that is where this can get to in terms of scale. And what we're going to be discussing today is how to hopefully go down that road and get to that type of size. But there are problems to avoid along the way. And I think everybody on here has some experience of that. So let's just talk about, first of all, some of the problems that people might face when they set out on copy trading. Fraser, perhaps you've got some experience in this area, how to be successful, but what are the pitfalls to avoid?
I think it's the start is the technology. It depends on the market. You're going into the advanced settings on certain technology providers. You mentioned eToro there. One of the reasons eToro is so successful is their proprietary system that they built on the back of some third-party stuff is very easy to use, easy to come in, easy to access. So what a lot of brokers do when they're coming into the copy trade space is sometimes they go with a premium provider, sometimes they go with recommendations, but they don't necessarily know their market value. If you look at the Asian market sometimes wants a lot more drawdown facilities attached to the trading to protect themselves because they're a lot more mature traders. If you look at LATAM, for example, what they want to make sure that people are paying like registration fees every single month to be part of their network because they're all used to being part of these multi-level network programs where a lot of it is multi-level marketing schemes, but it's education, it's this. You look at Brazil, for example. The stock market trading has been available to the retail market there since the 90s. CFDs only came in the late 2000s and 2010s. So it's a very experienced market, but you need to be catering to the market that suffices. Some products out there are mainly focused around CFDs, crypto, as you mentioned as well, but they don't necessarily support stocks and indices, where LATAM is very reliant on those things, and you need to take in rollovers and other things. So your operational risk is the starting point and something that brokers don't take into account to begin with.
Thank you. Barry, what have you seen that may go wrong in terms of people attempting copy trading but having problems when they start?
Yeah, I mean, it's hard to know this from the beginning, but my recommendation is, plan for the future, don't sort of plan for the now. And we talk about scalability, and technology is obviously one of the main components, but having 5 copy traders on a system versus having 10,000 is a huge sort of leap. So you need to have, the right liquidity partners, obviously, that can scale with the amount of volume that you want to be trading. You want the right technology. You also want the right people. So you want to have monitoring systems in place. You need to kind of build for where you're going to go, because the whole industry kind of builds on what is reputation. And as soon as you lose that, you kind of lose your business model, right? So build a system, build a setup like you mean to end, and not sort of the short-sighted, let's get up and running and wing it from there, because that's where we tend to see sort of the most cracks form with some of the broker partners.
So plan for the long term rather than the short term, basically, from the outset.
Yeah.
Maria, have you got any anecdotes or advice for those starting out?
So one of the reasons when we see customers coming over to us is the unexpected estimation of costs that it comes to with running the copy trade solution. So again, being able to choose a partner that you know that you can scale with. It's all well and good picking a provider at the beginning when you don't have the cost, while you're building everything, while you're actually getting yourself out there. And as they start to grow and volume starts to grow, especially if that tech provider is charging you on volume, I think they don't estimate how quickly it can go out of control and how quickly it can become so expensive. So definitely what Barry was saying about picking the right people comes again with picking the right partner. And I do think that is such a major thing of looking at scalability, because with copy trade, it can grow and it can grow really fast. So we find a lot of people coming over to us and saying, okay, one of the reasons we are choosing you is because you've got fixed monthly costs. You're not charging on volume. And so that is something that obviously helps them scale and be able to control the situation a lot more. Another thing that we tend to see is that when they also do scale, they're finding different providers that are coming to them later with different payment structures and performance fee structures that they want to set up. Maybe their technology doesn't necessarily have the flexibility to go with that. That's also something that we tend to see, that people don't think again into the future of being able to say, yes, this works now with the limited availability of what the tech can offer you. Does it have flexibility as you grow in the future to be able to offer other structures as you grow?
Okay, thank you for that. So let's just talk about why people get into copy trading. If it has these kind of pitfalls, what is the attraction of it? And before I go any further, I just want to remind everybody we are very, very open to questions. We do have some questions ahead of the webinar. So when people registered, some people added some questions, which we will come to. But as we're talking, please do feel free to add questions, and we'll get them answered. Nelson, I'm going to shine the spotlight on you for this one. Why do brokers get into copy trading? Is it a competitive pressure from other brokers? Is it something to do with managing the risk on the more successful traders and turning them into a profit center, and then growing the business on the back of that? What is the main driver for copy trading?
The value for most brokers will always be in large traders. That's the reality in the market. The volume is there, and you make good returns. But the reason for copy trading is simple. We're in a different world. Like, how many of us here, I mean, we all use LinkedIn, but how many of us use Instagram? How many of us use TikTok? How many of us use all of these things? Do we use it because we want to use it, or do we use it because of business? A lot of the time you pick it up because it's business, you need to follow. Some of it is because, someone sends you something. But today, business is done and people are attracting online. They're selling their signals, they're selling proprietary education courses, whatever it is, depending on the market, obviously, and the regulation. And obviously, certain regulators have become very hard on this. But brokers are seeing that people want to trade as part of a community. They want to feel part. People don't want to sit there isolated. They want to understand, they want to chat. And what a lot of these copy tradings have associated to them is WhatsApp, Telegram, Discord groups, where they discuss these parts, when they win, when they lose, and it gives them some reasoning, opposed to buying an EA online, which in essence was copy trading in the beginning. But it gives them that sense. And if brokers don't offer the copy trading, then you kind of are looking more at legacy traders. So a lot of it is keeping up with the trends, but obviously it's where the market is moving. And a lot of those traders who will come in with copy trading will also try to manually trade. So it's part marketing, part trends, part creating that community ethos. And there are brokers out there who are creating that ethos, but without the copy trading. But it's very hard. It's again, it's something you have to do. So and a lot of where the market is going at this moment in time, and a lot of the demand from IBs, from traffic generators, and you only have to speak to anyone at one of the events, and they say a lot of the people who are searching online on Google, they're looking to copy people. So brokers, if the demand is there, you're going to offer the solution.
I'm going to ask a cheeky question now. Have you ever come across anybody personally or anecdotally who has regretted ever getting into copy trading in terms of being a broker offering it out? Does any broker ever go, I wish I'd never started this?
I know several brokers who've gone for very premium systems, believed it's going to create, as I mentioned, that community ethos. But again, it comes down to the technology selection. They haven't necessarily gone to the right one. They haven't had the liquidity. And most of the time, it's the knitting between the technology and the liquidity. And maybe Barry can mention about the liquidity then.
Yeah, we'll come on to that. So it is, going back to Barry's point, prepare for the long term and everything should fall into place if you do the groundwork now, which is hopefully what this webinar is helping people to understand, how to get this set up correctly from the start. So what copy trading can actually amount to is a single burst of trades, and especially if you've got a very successful or popular master trader, depending on the scale of that master trader's following, you could end up with some very significant execution issues, which need to be thought about from the outset. So Barry, could you just give us some real world examples of how significant some of these trades can be and what happens after the master trader presses trade and what happens to the copiers of that master trader and how you as an LP execute that?
Yeah, well, I'll start real quickly on sort of typical liquidity aggregation, right? So you get a bunch of LPs a price and you get bids and asks and you create the spread. But the reality is that price is really generally good for one trade, right? So you're a broker and you send your price out to thousands of users and they all want to hit that trade. In the same way, copy trading, once they hit, it's not one trade, it's thousands, tens of thousands of trades, hundreds of millions in volume. And liquidity, by definition, is kind of not built for scale. So in our scenario, we tend to focus on customization. So we look at one client as an individual, and we tailor liquidity based on how they want to scale their business, what we expect in terms of volumes, in terms of spreads, and really drive the business based on data, right? So we look at the flow characteristics that they're sending through. We agree sort of consistent ways of handling that flow, which allows that broker to say, okay, if we have 10 copiers or 100,000 copiers, we can still build our business in that regard. So it does come down to customization. It helps to have, again, we talk about technology partners that can process that amount. You're only as good as your link in the command, right? So we distribute to technology, and if they misinterpret the data or they misinterpret our product, things can go wrong really quickly from there. So, but it does all come back to the transparency of what's going to come down the pipes, and then can you deliver on that promise to your client? And that's really where, so yeah.
Can I ask a question on that? Have you ever had a broker working with you just as a standard broker that you're providing liquidity to, and then they bring in copy traders without telling you? Has that ever happened?
It happens more times than I like to sort of admit, or rather would prefer. These things happen in bursts, and goes back to my original point, when you build for the future, do you have monitoring in place? Do you have risk management in place? Do you have a trading desk, a 24-hour trading desk that can communicate back to the client, say, we've seen this is different to your typical nature. If we continue on this path, where do we end up? So it's a very open-ended question, but it all comes down to, yes, it can happen, but are you also prepared for when it does happen? Because inevitably there are times where brokers themselves will be, this is completely unexpected. I mean, you get 100, 200, 500 to 1 leverage, you sort of open yourself up to these massive bursts. And like I said, it happens more often than the other way around, in fact.
So should it be part of your go live checklist, 100% that they should tell their LPs that they're about to launch copy trading if you hadn't already had that information given to you?
Well, I think it's like it's a snowball effect. So we have a bit of empathy for our clients. I mean, the sheer scale and the size of the number of clients and systems and sort of, they've got a whole lot on their plate. And I kind of like to see it as our job to also support them as a partner and say, hey, we've seen a change in the structure, or we've seen, this is coming through that you may not have picked up. So it's really a partnership. It's not like, hey, you should have told us in advance. I don't think it's, I think they've got quite a lot on our plate. So our job as a liquidity provider is to support that as much as we can.
Yeah, maybe Maria, when you go live with a copy trading client taking your technology, maybe that could be something that you remind them to do. So just give your LPs a heads up that copy trading might be coming down the pipe.
Yeah, and again, everything that Barry's saying, I'm kind of sitting here nodding. It is this thing where we're seeing brokers, because they're struggling so much with regulation and trying to acquire new clients, regulation is just constantly making it so difficult for them. They are trying to make do with whatever it is that they can to acquire new clients, and copy trade does seem to be one of those trends that has just taken off in the last year, if not more, of them finding it as a tool to be able to bring in new business and work with the existing clients they have to kind of grow that business. So yeah, it does come back down again to what Barry was saying with the transparency of it, that you want to be able to give them a tool that offers them, the broker, that transparency to be able to see what they're doing, how it's growing, and being able to monitor everything that would then end up saying, okay, if I monitor, if I'm keeping track of all of this, where then can I spot that there's concentration risk that will eventually end up becoming liquidity risk as well? And then on the back of that, being able to say, right, before that concentration risk becomes liquidity risk, why not have the proper risk strategy in place with tools like what I was saying as well, where we tend to see a lot of our clients saying, okay, if I'm bringing in copy trade, also do I have my dynamic margin tool in place to be able to help me with, margin tiering and lowering the leverage whenever it is that I see kind of concentration coming on, net open positions for the whole brokerage.
Okay, thank you. Can I just ask a question about toxic trading? Because when obviously that's a topic that's always in the air for people. When does copy trading become toxic trading, and how to avoid that? Is that again through discussions with your LP so they're aware of what might be coming down the track? How does that get managed? Who'd like to answer that one?
I mean, I'll pick that up. I mean, it depends on the definition. I mean, the reality is on copy trading, a lot of brokers are booking. That's the reality, because they're expecting, you mentioned a copy trader eToro there. I can't remember how many followers. 34,000, 100 million. I'm interested in the stats. How many of them are $100 depositors? Yep. Exodus has, a couple of million active copy traders, let's say within Africa. How many of those are using the $10 minimum deposits? So again, a lot of this trade size, we talk about this in LPs, and this is when you get concentrated flow and you accelerate up on how you manage it. And something that was being discussed here is that you speak to your LPs, speak to your tech providers. I think something that's constantly missed is speak to the signal providers. Give them the reality of the situation of what they're trading, how they're trading. If they scale from 10 to 100 people, explain to them the impact of that. Explain to them the impact of your book size. If you can't, if you don't want to take on new LPs, take different streams and stuff like that. The point is, as a broker, you need to be proactive. And traditionally, it's been the proactive side. Oh, I'll get better liquidity. I'll improve it for my client. Sometimes, there's only so much liquidity in the market to go around. Sometimes it's about, setting realism and saying, right, you're executing instead of 0.1 lot on 10 clients, you're executing 0.1 on 100 clients. This has a market impact. So what we want to do is, instead of you having 0.8 spread and seeing a 0.1 or 0.2 slippage, 0.3 slippage, we want to give you a 12-point spread. This means all your clients will get executed. We can service you better. And so it's not just about making sure liquidity, it's making sure you set the system up from the technology from that base level. And I think that's the important part. And I think when you talk about toxic flow, something that a lot of people pick up is, if someone's a profitable trader, it's toxic flow. Not all profitable traders are toxic flow, but all toxic flow isn't necessarily profitable at the same time. Some abuse, you're seeing one-sided abuse. I see it on a very regular basis where, and I'm sure Barry sees it come down the pipe as well, where you're seeing one-sided abuse. Again, that client might be losing and making your book money, but it's still abuse. That's the reality of the situation. So it's, how do you effectively have that? How do you have your communication points in? How do you pick it up? Are you hedging? Are you taking all the flow in, capturing the spread on a B book and then A booking out after a period of time? Are you sending it all to your LP and they're managing the flow with you, and you're being reasonable with your requests to them as well in terms of the execution? I think this is the key point, is what is your risk? Because each broker has a different toleration for what toxic flow is. I know Barry, for example, has some HFT, takes some HFT flow, which a lot of other brokers would not touch in the world because they feel it's toxic. But I know they're very happy with him and trading. Vice versa, I know others who can't, and they come to me and take the business as well. This is the nature of the market. It's on the individual's risk appetite. And I think when you're setting this up and managing the copy trading especially, you need to understand what you're aiming to do as a broker and where the concentrated risks are. If you're not willing to take that risk, discuss with the liquidity provider, discuss with the copy trader, and build something that's sustainable, not something that's a yo-yo 1-2 months, because that brings other operational risks then.
Okay, can I just refer back to one of the questions we had? Somebody who registered for the webinar asked the question, and they started that question with "be honest," which is a bit loaded, but be honest. How many brokers are running copy trading as clean A-book versus a hybrid, the actual economics? Now, I've always naively assumed that anybody that runs a copy trading program is 100% A-booking that. Now, I'm learning that that's actually not the case. But what would the proportion be?
It depends on the balance sheet. It depends on the broker. It depends on a lot of things. It depends at certain times. I'm pretty sure in December, January, and February, most were setting themselves to 100% A-book. But obviously, like if people come in, sometimes because a broker is warehousing, doesn't necessarily mean that they're trading against you. In some ways, they could be spread capturing and taking the risk against their own book and balance and hedging internally. There is always that. There is that operational management, and then they trade out and they're spread capture. So I think this B-book terminology of it means that the broker is trying to take the money from you. When you go into a casino and you play on blackjack and you win or lose, you don't claim that the table's rigged. But you're betting against the house. Whether you're trading directly with the broker or via ISAM or a settlement, there is someone always making the market. What you want to make sure as a trader is, does the broker have a good balance sheet? Do they have a decent reputation, and are they going to pay me? And if you have those kind of three things, then as a trader, you're going to trade with them. Now, as a broker, you need to instill that trust by building that out. And what you actually find is most brokers do have that, and most brokers, have a mechanism in place where they have risk limits, where some of them are A-booking. I mean, on a percentage, you couldn't really say. I would say it's a coin toss between 50-50, 60-40. Because there are a lot of smaller brokers that are just sending flow through because they're spread capturing, and there's nothing wrong with that.
Okay, so let's ask. Sorry, thanks for that, Fraser. Let's ask other people on the panel. Barry, what do you see in terms of percentage A-book, B-book as a general guide?
Well, I mean, I guess because we're a liquidity provider, we only know when it's on A-book. We do have, well, for sure. So clients range everything from 0% to 100% in terms of A/B book and we've talked about sort of toxic flow, which is terminology we don't typically use because it's an appropriate risk price. That's where we like to see it. So maybe a HFT strategy, no one particularly likes it. If you can price that correctly, then maybe there's an argument that you can accept it. And if you have a martingale strategy, for example, is something that the copy trading sort of scene has loved, which is kind of ultimately doubling up on your positions. And there is a case that when that scales too quickly, double in a position for a B-book broker, they get to these limits, which is frightening, right? You get into a yard of gold risk and you're going to a weekend with Trump on Twitter or X. So there's different strategies that require different sorts of hedging. But on average, we have partnered with a lot of brokers that experience the same thing, and those range between maybe 30 to 50% of the hedging. So what they do is they will trade on a book and see a reflection of a correct risk price for that strategy. They don't have to take on all the risk, but they are seeing the sort of correct market depth. They are seeing the correct depletion in what you would see in a typical model, rather than doing it on B-book, because all you're doing is giving them a price and you have no idea what that actual knock-on effect is and what that correct price should be. So I would say on average, 30 to 50% seems to be a sweet spot for the brokers to sort of partner with the LP. But yeah, like I said, it's everything from 0 to 100%.
Okay. Maria, do you have a sense of what the percentage of A-book, B-book is on
No, we wouldn't necessarily have so much visibility on that, but we do know that majority of our clients are no longer sitting there saying it's fully A book or B book. And to say fully A book is just not realistic. They wouldn't be able to, with copy trade, to be able to sustain that and everything that comes with it. So yeah, we are seeing it mixed. We're seeing, depending on their risk appetite as well, of, you know, being fully hedged or partially hedging some of those positions, and then seeing a mixed variation across the board. But yeah, never necessarily one-sided. It's always along the lines of mixed.
Okay, so is it the case that a broker would ideally like to B-book all of the flow, but there are points at which it's impossible to do that, so they have to work with an LP. Now, Barry, from your point of view, I think it's fair to say that ISAM or any LP would like to see all of the flow, because then they can actually understand the whole environment that they're dealing with. So if a broker gives you all of their flow, then you can understand everything that broker's doing. But when you're only getting partial amounts of the flow and the more challenging aspects of the flow, you don't have quite so much visibility. So I think it is fair to say there is an advantage to both sides if there is more volume coming from the broker in terms of transparency of the whole setup and everything else. So it must be challenging if you're only dealing with a portion of that business.
Depends. I think if it's transparent, let's say it's a 50% hedge ratio, you have a full understanding of the total volume. Obviously, from a pure volume metric, the more that gets on a book, the better. But again, brokers need to run their own businesses, and if they can monetize and service their clients on a B book model, there is some argument where, you know, real life hedging is sort of not optimal. Which for me is strange, but again, there are, you know, there's two sides to every coin. But again, it goes back to transparency. If you know what that percentage hedging is, you can work with your clients. You can customize the quote book and the order book and the refresh rate and how much volume you're anticipating to give them sort of stable conditions. Because that stability is again what they build, what these signal strategies all build on is, can we scale this? Can we get, you know, we didn't actually talk about like the cost of acquisition for a retail client has gone through the roof, right? So getting one client is expensive, but you get one signal and you have 10,000 clients. That makes your metric looks a lot better. So I think there's something there that brokers also have to sort of play with, and again, that's their game. But again, transparency is usually where we come into sort of what we can really offer as a liquidity provider.
Okay. Now, I'm going to move on to something that's perhaps a bit more technical. When I was working at an FX aggregator over 10 years ago, there was a challenge that I was presented with by perhaps the leading interbank ECN. They were in conversations with one of the leading copy trading platforms at that time, and they came to us and said, can we work on a project to help execute tickets of 50 million at top of book? Let's say $50 million in one clip at the top of book. Now that's the perennial problem, right? So if there's a very successful master trader who's got thousands to tens of thousands of followers, and let's just say theoretically there is a requirement for a 10 million to 50 million type ticket, you're no longer talking about top of book. So how does that? What's the actual reality of what happens when somebody clicks trade, 10,000 followers want to follow that trade, and then the ticket size in aggregate gets to this order of 10 to 20, 30 million. What happens in that case? What's the best way of managing that to try and get top of book price that created the signal in the first place?
I guess that question's directed at me.
Sorry, Barry. Yeah, I was looking at you on the screen. You can't see me looking at you, but yeah, it is aimed at you.
Look, there's no silver bullet. I'll use the word appropriate risk price for everything that we talk about, because that's how we see it. A top of book, if top of book is $5 wide, then yes, you can do it. But you know, the traditional, how can you get 10 cents for 50 million? It's kind of like, you know, you go to Costco and you get 5 for, you know, buy 5 get 5 free. Liquidity is the inversion of that, right? The more that you want, it scales with a risk price. So when we talk about risk appetite and how much you want to take on, you know, you can do that if you want to B-book it. But, you know, as a liquidity provider, we don't really have a concept of a B-book model. So, you know, I'm probably actually the wrong person to answer that, because the truth is, you know, you can do that, but it's going to cost you $5, and that's your top of book price.
So is it preferable that a broker, if let's say they're on an A-book model and they want to give the best execution they can, would it be fair to suggest they see a volume weighted average price rather than top of book price, and that's what they're trading against?
Definitely.
So they're getting
more on this, because seeing what you've done or how you add it as multiple liquidity providers, no, Fraser?
Yeah, I mean, like the thing is, you have different. Something Barry touched on there is, well, in a few points, is the different strategies and the different needs for it. So, you go with someone like ISAM, they could give you different feeds. You go with ISAM and multiple liquidity providers. You can do it in any build you want. The key to understand is, like, where is the touch point? Like, if you have clients trading on cent accounts, going and speaking to a liquidity provider and sending a trade of 0.001 is never going to happen. They're never going to speak to you on a ticket size. They don't want to have that discussion because there's nowhere to kick it. So they want to see some concentrated risk sent up. So you need to decide as a broker how you're going to manage that operation. And for me, like, how you get that price, again, take one big feed, chop it down yourself. If the liquidity is sitting there, most people now are sitting with PrimeXM, Centroid, 1-0 as their engines. There is an ability to take a larger book price, build your own price into it. But if you don't want to go to that, if brokers don't have the expertise, go to the professionals who know how to do it, explain to them what you're trying to achieve, and let them give you the solution. It might cost you some money. It might not make you as much money as you think it's going to be. But the reason they're giving you that answer is because that's probably the way to do it. And we only have to look at what happened really in December and January with some very large brokers and brands in this market who've disappeared. Now, whether that concentrated risk came from click trading or copy trading, nobody really knows. But I would probably say that the copy trading added on to the click trading, because I think all of us can say quite honestly, it was very concentrated. Everyone was very omnidirectional for very large periods of time. And if you don't have the ability to hedge, you're asking for problems, and you're only as good as your last day, and your balance sheet is only as good as that last day's close.
Yeah,
good point. Good. This actually goes to one of the questions that sorry, Maria.
Sorry, just to quickly add on that as well, is about your setup. It's with everything with copy trade as well. What we tend to see and talk about with our clients a lot is you're setting it up, you're going with copy trade. Great. Have you stress tested everything from your spreads to your rebates to your execution costs that are going to come with it? And then have you put scenarios in place to be able to deal with that concentrated risk that might come later? And that's, again, getting the right tools in place to be able to complement your risk strategy that you've got.
Yeah.
Sorry, Fraser, I just wanted to make sure we're answering the questions that we've received. So one of the questions was, how does the broker manage liquidity risk during extreme market events when large numbers of copy positions are sent? So I think this is what we're answering here, right? And then sorry, another question about volatility. How should brokers monitor copy trading exposure? How should brokers monitor copy trading exposure at the master, follower, and symbol levels, especially during highly volatile periods? All part of the same thing, really.
Yeah.
The high volatile periods, you can prevent those. It is about putting the right tools in place to be able to capture at sessions or at different times when you know that market news is about to come out, or you've seen certain patterns in the volatility that you experience as a broker, and having the right tools like the dynamic margin that will come in to be able to say, okay, I can create these sessions to anticipate that that's going to happen, to have, margin tiering to limit my exposure overall.
Okay, thank you. Another question, what role, if any, should the retail brokers play in managing the liquidity made available to their clients for copy trading?
Quite heavy in terms of how it's distributed out. Like, you might be getting X price from your liquidity provider, but are you getting leveled pricing, top of the book pricing? How are you disseminating it down? How are you passing it to the provider? What spreads are you offering? What rebates are being paid? Because this all indicates what your ROI is. And if you're giving someone a fixed spread and the market goes volatile and you are losing money on the hedge, well, you're losing money on acquisition, you're losing money on the trade, and you're losing money on the hedge. So you're not running a broker, you're giving away free trades.
Yeah. Can I ask a question about regulation and which territories that there may be challenges to offer copy trading in certain territories? Is it a free market worldwide? Are there certain territories where the brokers should be more careful?
I mean, you've got the obvious markets, FCA. You have the FSCA in South Africa, which are very heavy. They actually introduced new laws through Parliament, targeting not only what we classify as finfluencers, but anyone offering financially managed services, signals, or telegrams. So they've come very hard, very big fines, and in some cases, actual jail times. Australia, very hard as well. I mean, most of the markets, where you would say are more traditional markets, where they have a structured financial managers and these kind of things. They're very difficult markets to go into, but they're also there for a reason, because it's for consumer protection. Any broker who's coming in, you need to have safeguards in place. There are reputational risks. If you are thinking these copy traders are going to come in and lose all their money, and they're going to bring hundreds or thousands of followers, and all those people lose money, where's the risk? Is your reputation. So you have to balance the liquidity, the operation, the risk appetite of the business, not just for making money, but the risk appetite for the business on how they want to operate. Not all copy traders, just because they bring you money or deposits or volume, are necessarily good for scalability long term.
Okay. I presume we could go on to the part of this where we could ask the panel, what do you think people misunderstand about copy trading in general? What do you think, if you could change one thing about how the industry talks about copy trading, what would it be? And that's a very broad, open question. But from my personal point of view, copy traders who have a successful track record, and they're very transparent and it's provable, I think copy trading is a very good thing, because if I'm a new trader, I don't really understand the market, it's probably safer to follow somebody that does and has got a long track record in that. So I think copy trading very naively should be something that regulators should actually welcome. That would be my answer to that question. Does anybody else have any contributions to that, about how the industry could perhaps change its perception of copy trading?
Well, I mean, at least for I don't actually see it. I don't personally see it as a negative. I didn't actually know that a negative connotation. I think, obviously, with the rise of AI, of the rise of sort of retail access to information and markets, the symmetry between what an institution knows and what the retail market can get access to in terms of risk management. So we talk about, it's not just making money, but it's not losing money. I feel like it's quite a strong place, and I'm not surprised to see it scaling the way it does. And we alluded to, like, everyone wants to feel part of a strategy or part of something, and kind of, if anything, it's access for the retail to participate in the financial markets in a much better a better way. So actually, I wouldn't have thought it had a negative connotation, but I guess there are certain things that have happened in the past which is kind of lingering around. But for me, it feels like it's in a really good space.
It's really just the regulators, I suppose, perhaps not understanding the benefits of it, or being concerned about, obviously consumer protection is at the heart of what they do. And personally, I think that copy trading adds to that consumer protection if done correctly. Maria, do you have any thoughts on how the industry could perhaps change its view on copy trading?
Yeah, we didn't, same as Barry, we don't see it as something negative. In fact, one of the most frequent requests that we get is about copy trade. So a lot of brokers, even where we were seeing some of the shift going from, okay, we're switching from to copy trade, or I'm moving to copy trade instead, we find it's more beneficial, or whatever reason. But it didn't come with a negative connotation, but maybe on the regulatory side is maybe where that might be coming. So we're still waiting for this, or for approval for this license to be able to move with on whichever license it is that they're trying to offer it from. But nothing from brokers, as far as we're concerned. It's one of the most sought after tools that we have as well.
Okay. Did you mention previously on a call we had before that there was a linkage, or can be a linkage, between copy trading and MAM structures?
Yeah. So a lot of, again, of what we're seeing, that we're actually seeing people say, even if they're not getting rid of their MAM solution, trying to ask and see where they can actually link them across. So one of the common requests that we've seen across the board from quite a few clients or even prospects and leads coming to us is saying, can we take your MAM technology and your copy trade technology, have somebody set up as a master investor in the MAM solution, have somebody in the copy trade solution set up as a master provider. That master provider's account is linked to the money manager as an investor following them. And then in the same sense, in the copy trade solution, it's then being able to take the signal of whatever it is that the master's done, follow it into this account, and then that account in the copy trade is set up as a master provider, which will then have a bunch of followers copied to it. So it's kind of creating a little chain that's going along, which technically possible. Regulation-wise, I don't think anybody's caught on yet to kind of come and say no, slap on the wrist, whether it's allowed or not allowed. So we're seeing people asking if that's a possibility as well, as far as functionality is concerned.
So a little plug for PLUGIT, that is possible with PLUGIT's technology. Is that fair to say?
Yeah.
Yeah. Okay. So Barry, I think we need to ask a few more, well, one or two more questions about liquidity management. Is there anything that you would like to advise retail brokers in terms of the challenges or the problems? Just some words of advice about how to work with a liquidity provider, some general words of advice on managing copy trading. So maybe make the LP aware from the outset that you're starting copy trading, what to expect. So maybe just a few words on that if you can.
Yeah, I think it starts with managing expectations both ways. So again, partnerships very much, the liquidity and retail broker aspect. That's the way we like to see it. It's for us at least. It's always data driven, right? The more data that we can consume, the more data that we can analyze. We can give consistent feedback back to those brokers, and then that moves up or down the chain depending on your direction. So that's certainly one of the main aspects. And again, we talk about scalability, right? Like plan all your businesses like you want to be the next, $4 trillion broker, and find partners that, maybe don't have the same model as you. There's a lot of B-book shops that hedge to another B-book shop to another. Like that doesn't really scale well. So there's, I could probably speak about this for hours in terms of how you select the correct LP, and I'm also trying not to be very biased on the ISAM front, but
you're allowed to. You're allowed to.
Have the now. More the point is have the conversation, have honest conversations with your LPs. Let them know what you're expecting. Let them know the red flags, things that you just can't tolerate, and let them know where there's a bit more leniency. And often, sometimes, you kind of, I wouldn't say you pay for what you get in terms of like absolute cost, but you have to be realistic about, what is too good to be true versus what is real market activity, what is real consistent and stable product, which, will be with you for the next month, 6 months, 2 years, through, good times and bad times.
Okay. I am going to allow you just to do a quick pitch for ISAM. So why should a retail broker choose ISAM as a partner?
Well, I think the first thing is customization. We run all our models, all our tech stack is extremely low latency technology, so it scales really well for why a lot of the big brokers partner with us, because it allows them to trade one lot the same as 1,000 lots, and as they grow, we grow with them. And again, it's the customization. You give us data, we analyze it, we give you proper feedback on what we can handle, what we can't handle. Open conversation, extremely transparent, and we can actually deliver on the promise. There's no this liquidity provider widened or this tech let me down. We sort of have those controls at our fingertips, and kind of we're proud to say that if we say we will deliver, then that's what we do.
Great, thank you, Fraser. You've just moved to a new company. If I'm a master trader out there and I think, I'd like to go to Azul Markets, what would be the sales pitch you could give them? I'm not sure if Azul has copy trading, but let's say in the future you do. Why would somebody want to work with you?
I mean, the one thing that we're referring to is copy trading. And like one thing I'd like to ask everybody is like, at what point do you stop treating a successful retail like social trading product as that and start treating it as an asset managed product? And in my opinion, that's the key point. Is like you want to go to a broker, and Barry mentioned it with liquidity providers as well. You want to go to a broker that's done it before. You want to have the people there grown a broker before. Do they know what they're doing? What tech are they using, and how have they done it? Something that most people who know me will say is that I'm a little bit too honest sometimes, which annoys people. But I'd rather give you the reality from the beginning and not waste your time and my time. And I think that's the key to me. You've got honesty, and I'll build out what you have. I might not give you the tightest spreads, but I'll make sure you get the execution you need.
Thank you. Maria, could you just give a little bit of a pitch as to why somebody should choose PLUGIT copy trading solution?
Yeah. Well, we're talking today a lot about liquidity and everything coming back to it. And at the end of the day, yes, liquidity risk is there. It's even worse if you haven't taken the step to find the right technology to actually send it across at the first place. So yeah, when it comes back to technology, being able to say that you're finding a tool that is cost effective, is transparent, offers you all the functionality, make sure that stability is also there, definitely push them to the limit to ask, has this been stress tested across your system with other leading brokers? And that's one thing that I can definitely say for PLUGIT is we're not going to make you trip up over your own shoes. And I think that was one of my comments as well on Facebook to one of the questions was, you're going to have the other risks that are going to come on the back of it. Don't let step number one, which is having the right tool and the right partner by your side to be able to say that when you do go running, you're not going to trip up and fall over yourself, and that you're able to actually send the order across without any failure. So yeah, with us, we tend to work with all our clients as partners. So it is that we listen a lot to what they have to say. We take on board a lot of the requests that they come with, and we understand that not every broker is the same, and we do try to accommodate that.
Great, thank you very much. So I'm just going to make a little pitch for Liquidity Finder at this point. I think I'm allowed it. We have recently launched a new version of the site, and with this webinar, we're going to put that on Liquidity Finder with the ability to have comments at the bottom of the piece, so people can continue the conversation on there. If there are any questions for any member of the panel, you can carry on the discussion on our site, and also contact any of the people on this panel through Liquidity Finder also. So I hope the conversation continues after the webinar on Liquidity Finder. If you haven't yet checked it out, please do. Create an account if you don't already have one, and feel free to post comments and post into the feed. We'd love community participation. So this isn't the end of it. We'll carry on Liquidity Finder, and do feel free to contact everybody on the panel if you have further follow-up questions. But I hope that's helped people today understand a little bit more about the challenges and the successes that can come from copy trading. Thank you very much, everybody. Great to see you. Thanks for participating if you turned up this morning. Thank you. Bye-bye.
Thanks, everyone.
Thank you.
Okay.